Welcome back to America's Commercial Real Estate Show, your source for intel, forecasts, and success strategies. I'm Michael Bull. The segment is brought to you by BOMI.org. That's B-O-M-I. They are the industry standard for training and education for facilities and property management. Check them out. Well, our show today is called 2019 Now. What is going on? You know, a lot of people are concerned. We've had a government shutdown. We had a December rate hike. We have tariffs. We have people kind of shaking in their boots. So I want to bring back the experts that have told us what we should expect for 2019 in the past and see what they say now. Please welcome Mitch Roschelle. He is a partner with PwC and he's here in Studio One with us. Mitch, thanks for being with us.
Thanks, Michael.
So Mitch, you've told us before 2019 was going to be good. Everything was going to be rosy, at least I think you said through 2020. But things seem to be, there's been some upheaval in the stock market. People seem a little nervous. What do you think?
I think you have to decouple what's going on in the stock market from virtually everything else. It all started in the stock market in early October when Chairman Powell indicated that because the economy was so strong, they were going to continue to raise rates. The December rate hike, he signaled that was likely going to happen, and it did, and maybe as many as 3 or 4 rate hikes in 19. And at that point, the market freaked out. What's interesting, though, is, and I'm talking about the public stock equity markets for a second, right. They went up precipitously, almost from the election through October. And that was backed up by corporate earnings. The folks who invest in equities love the idea of deregulation. They love the idea of tax reform. Tax reform was promised and got delivered. Deregulation was starting to happen. And that was flushing out in corporate earnings. Corporate earnings were up double digits, in many cases almost as much as 30% year over year. And that was fantastic. And then all of a sudden, the worry beads came out and people started freaking out. But if you decouple what's gone on in the market from a volatility perspective and look at the underlying fundamentals of the economy, still strong. The thing that's interesting, though, is our economy in the United States is part of a global economy. And let's leave out the debate about globalism and nationalism for a second. But our economy is linked to other economies around the world. And because other economies around the world are starting to slow, there's a fear that there'll be a knock-on effect in the United States and our economy will start to slow as a result. That may or may not be the case, but that's what got into the soup that started to get people to freak out. But this is the commercial real estate show, and your question's probably about real estate. If you look at the fundamentals behind commercial real estate, nothing has changed. So I would say my personal view is 2019 is going to be as strong as 2018. 2019 is going to be as strong as we forecasted in emerging trends in real estate. But we're sitting here in January, and I could absolutely be wrong, and then you'll never have me back again.
Yeah, we're taping at the end of December here, and your sentiment about the future, has it changed in the last month? I mean, you have a government shutdown, you have what's, as you mentioned, the stock market gyrations. Any change in your sentiment?
Well, let's look, if we're talking about real estate for a second, let's think about what drives that. Decision by a landlord to invest in an asset, a decision by a tenant to lease an asset, a decision by a property owner to build on a piece of land. Those are the things that happen in real estate. So are people going to change the way they view investment decisions, whether it be the decision to pay rent, the decision to buy a building, because they're worried about stock market volatility, the Fed shutdown, the Fed raising rates, a government shutdown, a trade war with China? I don't think so. I think that the fundamentals are still strong. We have not built new supply in housing, single-family housing. We're still underbuilding new supply in multifamily housing. We probably are over-retailed. We most likely don't have enough office space in the places where people want to live, work, and play. So all of those things are still fundamentally strong. Corporate profits, by the way, corporate profits in 2019, year over year, aren't going to be as strong as they were last year, because last year got the one-timer for tax reform benefits. However, when you talk to stock analysts and look at their forward forecast for corporate earnings for 2019, they haven't really changed it as a result of what's gone on in the last couple of weeks. And if corporate profits are strong, that's going to be the thing that drives the decisions that are good for the commercial real estate industry.
We play devil's advocate with you here for a moment, because obviously I'm a proponent of commercial real estate. But if we're having gyrations in the stock market, if that's making consumers skittish, if that could that affect the job market, consumer confidence, job growth, which obviously then you start seeing some trickle-down effect of commercial real estate moving forward. Did that give you any indication of a change?
I feel like I should reach down and pull out a MAGA hat right now and stick it on. Okay, so we have 7 million people in America looking for jobs, and we have 6 million unemployed people. There are a million more people there's a million more jobs than there are people unemployed. Wage growth is north of 3% right now. Inflation is well below the Fed target. All of those signals for the health and strength of the economy. I looked right now, the Atlanta Fed does something called GDP Now. It's a great forward look of GDP. What they do is they take any economic data point that pops up, they stick it back into their model and it changes their forecast. Their forecast for fourth quarter GDP growth is 2.9%. It just came down from 2.7%, I'm sorry. It came down from 2.9%. But that means that 2018 will have a north of 3% GDP growth. And we could spend, an entire segment unpacking GDP growth. But the fact of the matter is our economy is fundamentally strong. And you asked about the consumer. 70% of the economy is driven by consumption, meaning what consumers ultimately spend. Look at holiday shopping this year, north of 5% year-over-year growth. So I think that the consumer is ignoring a lot of that noise. There's the risk that there's a wealth effect, whereas consumers say, oh my gosh, my 401k isn't as valuable as it was, and they start changing their behavior in 2019 as a result. But we don't see any really advanced signals of that. The only thing that if I were to wear my worry hat for a second, is much of what was spent in holiday shopping, which is just shy of $1 trillion, okay? Most of that money was put on credit cards, because most people do that, right? They buy something, they put it on a credit card. For those people who don't intend to pay that off in January when the bill comes, could that become a drag on our economy? Because we're starting to change the composition of balance sheets of consumers, and consumers get more cautious, meaning they consume less in 2019, and that slows down our economy. That's the only thing that I think is a bit of a risk out there. But otherwise, the economy is very, very strong. And unless we saw job numbers on a monthly basis that started to reverse, I think that all of this is good for 2019.
You mentioned that spending is the root of all evil. It really impacts the economy, and consumer confidence is important. So what about rate hikes, interest rates moving forward? If consumers, how's that going to impact the housing market and potentially the economy moving forward? What's
interesting, though, is the 10-year Treasury is still well below 3%. And as the rates were starting to get hiked, and that's the short end of the Treasury curve, the long end of the Treasury curve was moving up in anticipation. We saw some big, but every time the 10-year gets to 330 or something like that, for some reason it sort of drops back down again. So it doesn't look like there's a lot of upward pressure on interest rates on the long end of the curve. The thing that is worrying is as the federal government continues to borrow to fund a $1 trillion budget deficit, is that going to derail our economic growth a little bit because we have such a huge mountain of government debt. But if our economy continues to expand at this close to 3% rate, and we can continue that trend into 2019, some of that gets paid for in the form of economic growth and more tax revenue. So I do worry about government debt probably more than I worry about consumer debt. And also corporate debt. Companies were borrowing a lot of money because they didn't think the window was going to be open for too long for low interest rates. So they did sort of load up on debt. So you do have a lot of aggregated corporate debt, but by the same token, there's a ton of cash sitting on the balance sheets of those corporations. And I think 2019 is going to be an M&A boom in corporate America, which also gives rise to a lot of real estate transactions as well. So if you add all that stuff up, I think it's net positive. If we did that sentiment survey that we do in Emerging Trends right now, I think, well, it depends on how much eggnog the people responding to the survey were drinking. It's possible that it would drop down a little bit. But interestingly enough, there's stuff in the headlines all the time when people are responding to those surveys. And there have been many years where there's been a huge sell-off in the summer in the stock market, and the stock market dropped 6-7% or something like that. That's right when we dropped that survey question to respondents, and for the most part, they've ignored that. So I think that the economy is still fundamentally strong, and as I've said repeatedly, the economy is strong enough and has enough momentum. Only one thing could really derail economic growth, and that's a policy blunder. So what could that look like? The Fed continuing to hike when they shouldn't, policy blunder. Trade spat gets really nasty, potentially policy blunder. And lastly, does a split government, meaning Democrats controlling the House, Republicans controlling the Senate and the executive branch, could that dysfunction give rise to policy blunders like rolling back regulations that could derail economic growth? Short of policy blunder, the economy continues to chug forward.
Yeah, and that last point you made, is that what's making people nervous, that maybe we've got the government's not going to work as well moving forward?
Well, you point me to a government that does work well.
That's ever worked well.
That's ever worked well. What's interesting, though, and I do a ton of Fox Business, as you know, and I've been on a ton of panels on the air when we thought prior to the midterms, when we thought it was likely that the Democrats would probably control the House, which they will, Republicans would control the Senate. And all the pundits were saying, you know what, gridlock is good. The market likes gridlock because nothing changes. And what's interesting is I would say that the stock market, you began with stock market, so maybe I'll sort of come back to it. The stock market has been impervious to all of that noise in Washington. Just impervious to it. And they were looking at corporate earnings, and corporate earnings continued to deliver. Then all of a sudden, they hit the pause button for a second and started paying attention to Twitter and seeing what was going back and forth. And that started to bake into their calculus a little bit. I think it's the trend of rolling back regulations being derailed by Congress somehow trying to enact legislation to stop some of that. So banking regulations, Dodd-Frank's being rolled back on the margins. The fiduciary rule, for example, with the Department of Labor that impact investments, that got rolled back. Some of the EPA regulations that have gotten rolled back, and so on. If that changes through legislative action, or at least stays the pattern of rolling back regulations, that is something that does concern investors. So we'll have to see. All
right. We're talking with Mitch Roschelle, partner with PwC, about what he expects for 2019 moving forward, especially with kind of the recent changes we've had in the economy and the political scene. So is your outlook for interest rates changed any, and what do you expect moving forward?
I think the challenge with interest rates is you have to look, what the Fed does is part of the calculus. Then you have to look at how much debt there is out there in the marketplace and what people are willing to pay for it. You know, China is a huge sovereign buyer of U.S. Treasuries. Does China's views towards the United States in the trade spat change their behavior as it relates to buying our paper? And if it does that do something to change interest rates? Does Brexit and the ripping apart of the European Union and their central banking function, does that give rise to a shift in interest rates around the globe where other sovereign debt looks different than our debt? Those are the things that are going to impact interest rates more than another 0.25% hike, another 0.25% hike. And what's interesting is all the talk about the inversion of the yield curve. The question really is, and this is rhetorical, so don't ask me to answer it, but does the inversion of the yield curve foreshadow a recession, or does it create a recession? And that's something that I don't know. But we did see inversion between the 3-year and the 5-year a couple of weeks ago, and that caused algorithms that trade stocks to totally freak out. Inverted yield curve sends like shockwaves through the markets. So that's hard to tell. But I think it's going to be the supply and demand of debt and what people are willing to pay for that debt and how much coupon they want on that debt in all of the auctions for all of the Treasury securities around the globe. That's really going to dictate what rates are like and what credit spreads look like on corporate debt. Right now, that market's shut down a little bit. But when corporate America goes out to finance their balance sheets, what do credit spreads look like on corporate debt? That's going to dictate what interest rates are like. And if they do go up 100 basis points, no question, that's going to slow down real estate, no question.
All right, well, you sound pretty confident that the commercial real estate market is going to continue to do well. But I'm sensing that you're not as confident today at the end of December as you were when you were here for Emerging Trends. When was that?
I was here in October.
October.
Yes.
So is there a little, you're a little more concerned?
I think what's interesting is a bright light has gotten shined on a lot of issues in terms of how it influences investment decisions. And that's what caused me to sound more concerned. Or it's lack of sleep. It's one of the two. But what's interesting is let's just talk about tax reform and corporate decision making and how that really works. So Trump gets elected, promises tax reform, ultimately delivers tax reform within 12 months of inauguration. Corporate America did not know if that was going to pass. So corporate America was not making any decisions based upon a campaign promise until it got signed by the president. They weren't doing anything. So we've really, that law, Tax Cuts and Jobs Act, has been the law for 12 months. In that period of time, 9 months were smooth sailing, and then all of a sudden all this stuff happened. Corporate decision makers haven't really had an opportunity to lay out the plans that will derive the benefit from that piece of tax legislation. Changing the global tax scheme, lowering corporate interest rates, basically making pass-throughs tax preferred. All of those features haven't really flushed through. Even the $10,000 limit on state and local tax deduction, that clearly looks like the housing market is having a hard time having some indigestion with that. But we don't even know that yet because until people file their tax returns, which are due in April of whatever, 15th-ish, I don't know what day of the week the 15th falls in 2019, but people aren't going to really know how that hurt them or didn't hurt them until well into, so there's a real lag effect with fiscal policy, and we need to let this play out, and that's going to be the challenge. So I'm still net optimistic that tax policy was pro-growth and the right policy. I think what the investment community is worried about is it's not going to be given enough time to germinate, or I think that's the right word, and create the growth that it was designed to provide.
So I can still do the Snoopy dance then?
Yeah, I believe I tweeted a picture of Snoopy doing the dance and tagged you in it. Yeah.
All right, Mitch. Well, good information as usual. Thank you for joining us.
Thanks, Michael. Happy New Year.
All right. And thank you for joining us out there across the country. Appreciate you liking the show on Facebook and connecting with us on LinkedIn and Twitter. So I hope you had a great new year. And until next week, be sure that you always lead, learn, and laugh. And join us for America's Commercial Real Estate Show.